When Andy Jassy took over for Jeff Bezos as the CEO of Amazon, we were a little bit nervous. We were nervous that Amazon might not be passing down into capable hands. But as we look at Amazon's Q3 results today, and we look at the fourth quarter guidance as well, we are getting more and more confident that not only the company is in good hands, but it's in the right hands. We'll go through all of the financials and we'll show you that this once unprofitable company is now screaming out massive amounts of profit. In fact, their profit growth is growing faster of any of the Mag 7 stocks outside of NVIDIA. We'll talk about how much more room does the stock have to run from a technical perspective, and we'll do that all for you today. What is going on, investors? Hopefully you guys are doing well out there. If you've owned Amazon stock over the past year, you're up 40% year to date. You're up a solid 22%. Things are looking great over at Amazon. Q3 numbers came in $158.9 billion of revenue. In a moment, we'll come over here and we'll show you not only is the company churning out $158 billion worth of revenue, but now they're starting to churn out a lot of operating profit, a lot of net income over at this company. Very exciting. We'll also look at the different business units. It used to be AWS was the only thing that made money over here. Newsflash for those of you that are still stuck in the past. The e-commerce business is probably going to be the most profitable business unit that this company has at some point, I think, in the really near future. Now, company grew their revenue by 11% year over year. They also gave us Q4 guidance, which the company always does. They tend to give it to you in a relatively large range because the holiday shopping season and really any quarter for Amazon can have some fluctuations there. $181.5 billion up to $188.5 billion. So you got about a $7 billion spread starting at about $181 billion. Wall Street consensus was for 186. The high end for the next quarter was actually 188. So the company, at least from their high end estimate, well, they're coming over and above the high-end estimate that was already anticipated at Wall Street. And even when you look at the midpoint between 188 and 181, well, you've got a number pretty close to 186. So the company doing everything that they need to do to convince Wall Street that they're going to continue to grow 9% in the upcoming quarter, probably upwards of 10%. Really, the question mark is, can you turn the corner into a new year and grow at 10% margins? Obviously, some election stuff, some tariffs, some corporate tax rate stuff. This is all stuff we'll have to address in the week ahead as you've got elections. We'll leave all that aside because we've got a lot of numbers to talk about when it comes to Amazon. $158.9 billion in revenue. Last year was $143 billion. I don't want to just gloss over this. This is a company churning out in 3 months over $150 billion worth of revenue, and they just guided for a quarter of $180 billion worth of revenue. So clearly this company, along with Walmart, really are in a stratosphere of all to their own when it comes to revenue. We've always talked about with Amazon, they have all this revenue that eventually they're going to start turning the screws on their operating expenses and they'll start churning out profits. And after Jeff Bezos left, that's exactly what Andy Jassy has done. Give the guy credit. He's made some tough decisions. He's laid people off. He's controlled the cost. Look at your fulfillment cost. Folks, I want to remind you that our sales over at Amazon went up 11% year over year. Our fulfillment cost went up just fractionally from $22 billion up to $24.7 billion. Our technology and infrastructure, 21.2 up to 22.2. Sales and marketing barely budged. So this company was able to squeeze out higher sales on basically no additional sales and marketing staff. We've seen that across mega cap tech during this earnings season. General administrative ticked up a little bit as well. Overall, our total operating expenses went up from 131 to about $141 billion. So we grew about a little over $15 billion to our net sales. We added about $11 billion or about $10 billion to our expenses. That means our operating income is going to explode from $11 billion last year all the way up to $17.4 billion. The company also gave us guidance essentially for operating profit in the next quarter, the fourth quarter. So we're going to have somewhere in the $180 billion worth of revenue. Operating profit expected to be between 16 and $20 billion. So you're likely, if they come towards the high end of that estimate, to have, again, sequential growth on that profit side. Pull down to a net income number, and you made about $18 billion. Here's what I want to show you, because when you stretch this out to a 9-month view with Amazon, it gets even more impressive. Look at the last 9-month operating income. You had $23.6 billion of operating income last year. It doubled. So this company, then they didn't double their revenue. Their revenue went from $404 billion up to $450. Impressive growth, especially when we're talking about numbers this big. But your operating income doubled. Again, this company finding efficiencies across all of their business lines, not increasing their expenses as rapidly as their revenue is growing, and they churned out $47 billion of operating profit just over the past 9 months. Very excited. This company will easily eclipse $60 billion of operating profit. And obviously it has us excited about the upcoming year. Where this company has made the most headways, we'll get to AWS here in a minute. It's still a cash cow business. It'll still likely be the biggest from a profitability standpoint. But look at your North American e-commerce business. Last year, you made $4.3 billion of operating income there. Now you made $5.7. So forget all the noise about all the old investors that don't open up these financial documents and say, Amazon doesn't make a profit. Amazon is only profitable because of AWS. It's not true anymore, and it's never going to be true again. So off of $95 billion of revenue in North America, they churned out $5.6 billion. Now they have an international business as well. This is even more exciting, folks. We've been talking about this business unit has not been profitable other than maybe a few quarters during the pandemic. The international e-commerce business has simply not been profitable. But look at the most recent quarter. Off of $35.9 billion in revenue, we had operating profits at $1.3 billion. That means just on your e-commerce business, you churned out almost 6.9, nearly $7 billion worth of operating profit. AWS, for its take, during the most recent quarter, churned out about $10.5 billion of operating profit. In fact, that grew over the previous period at about $7 billion. The revenue went from $23 billion up to $27. So this is a fantastic, profitable e-commerce company with also the largest cloud computing, both from a revenue standpoint and I believe an operating profit standpoint as well. This company is worth $2 trillion, and I think it probably should be worth a lot more just based on what I'm seeing here. Now, the balance sheet is completely fine. Company has plenty of cash on the balance sheet. It's balanced off with some long-term debt, but it's nothing to be overly concerned about, at least at the current time. From a cash flow perspective, this is where you get a great insight into this company. For the last 3-month period, the company chopped out just $26 billion worth of operating cash flow. Just over the past 9 months, the company has generated $70 billion of operating cash flow. Now, the company has a lot of things that they need to invest in. We'll just analyze this on a quarterly basis. We have that property, plant, and equipment. And this is what we're monitoring if you're into the semiconductor industry. Amazon's property, plant, and equipment is a mix of data center and fulfillment center. So it's a little bit different than when you look at a Google, a Meta, or a Microsoft. This company does have some fulfillment build out here, but I think the mix is a lot lower than when it was during the pandemic. You had $22 billion worth of property, plant, and equipment. That's certainly bullish enough for the semiconductor industry. Certainly the read we got from Microsoft and the rest, and certainly Intel's results after the bell certainly shows that there's still plenty of spend going on inside of the data center. So we made $26 billion of operating cash flow. We spend about 22.6 of it on this property, plant, and equipment. Company actually paid off some debt in the most recent quarter, and they added a little bit of cash to their balance sheet. Everything about Amazon is looking exactly how you would hope it would look given the scale that the company has already achieved. Online stores sequentially went from 6% growth up to 8% growth. This time last year, you were growing about 6%. So they've actually expanded the growth rate of their online stores. Physical stores has actually accelerated over the last quarter, went from 4 up to 5, although that's a relatively similar growth rate to what physical stores has experienced over the past year or so. third-party sellers are struggling. I sympathize with these people. I once had a rather large e-commerce business that I was running on Amazon. The margins have kind of shrunk out, and the pandemic was just a juicy time to be obviously selling stuff online, with a lot of stores being closed or people not wanting to go to stores. That has kind of spread out, and you only grew at about 10%. So the company's going to likely have to address that, or just kind of suck up a lot of the inventory and just turn them into kind of online sales, first-party sales. My guess is the company's probably going to go that route and just keep the third-party sellers that they have. Advertising revenue grew at 19%, somewhat disappointing. It's the lowest print that we have on the previous 5 quarters. Slight deceleration there. It could be that you have some moderating of online advertising budgets as we head into the fourth quarter. We'll certainly see here, but the biggest takeaway, though, is as the third-party sellers decline in terms of their growth rate, well, they're the ones that are funding a lot of this advertising. Yes, you have CPG brands and programmatic ads that are appearing on Amazon, but it's really these small sellers are the ones that are going to have the advertising growth. So the company is going to have to address this at some point. They're either going to have to do something to cater to third-party sellers by cutting fees, increasing the service level, making it a better incentive to sell your goods on Amazon rather than go to a third party like a Shopify or some of these other marketplaces. Company's going to have to address this in order to re-accelerate the advertising revenue, in my opinion. Subscription services, which is a lot of your Prime stuff, that grew about 11%. That's been steady over the past several quarters. And your AWS growth coming in at 19%. It's very similar to the growth that you saw in the core cloud over at Microsoft. That minuses off kind of the AI cloud. And it is, I think it lags behind Google as well. So, but they're at a much bigger run rate, or a relatively much bigger run rate in terms of revenue, coming in at about $27.5 billion. Now, the question is, how much more room does Amazon have to run? The shares are obviously up big time year to date, and over the past year, we're seeing in the after hours, we've popped from about 186 up to 193. That doesn't really confirm a new higher high on the technical chart. You really like to get back up in here to the $200 range with Amazon and actually push through that. That's kind of the bull case scenario where we go from about where we're at with Amazon. So if you're sitting on the sidelines, you like these numbers moving into a fourth quarter where we got clear guidance on just the revenue side and the operating profit. And at the very least, it meets expectations. And on the high end, we're certainly going to exceed expectations over at Amazon. I'm seeing enough from this business from the e-commerce standpoint. This is what has me the most excited about Amazon. And this is what was so frustrating about owning Amazon for a long time, like I did, is this e-commerce business was generating so much revenue, but they were burning through all of it and more in terms of operating profit. And now it's turning into a hugely profitable business. And I think they can turn the screws even more and actually make this the most profitable business unit inside of Amazon, overtaking AWS, which is still wildly profitable. I think out of all the Magnificent Seven stocks, or whatever you want to call them, the one that could double its valuation relatively easily without having to do anything transformative, like have AI come along like NVIDIA, or have Apple release some new device that is better and bigger than the iPhone, and you can go down the line. Amazon can continue to do what it's doing. And yes, it is trading at 40 times forward, but as we see quarter after quarter, they continue to make improvements on those operating income. They continue to like double their net income year over year. This is the company that could probably comfortably double or at least add significantly to its market cap, where the rest of the companies have continued to gotta innovate and potentially create new products, whereas Amazon could just keep doing what it's doing. Hopefully you guys enjoyed today's video. We got lots more to get to later today. Good luck with your investments.